All right, folks. So welcome to Investing for Beginners podcast. Today we have a special show. We have our friend Brian Feroldi back. Brian is a financial educator at Long Term Mindset. He is also a wizard, a financial wizard on X, LinkedIn, YouTube, you name it. Brian's there and he's dropping lots of knowledge and he's going to share some stuff with us today. So, Brian, thanks for joining us and welcome back to the show for the 17th time, I think.
Dave, Andrew, good to be here as always. Thank you for having me.
You're welcome. All right. So we thought today we could talk about Warren Buffett and why he thinks earnings per share is overrated. So what are your thoughts on that to kind of start our conversation today?
Yeah, that's a cheeky start, isn't it?
Yeah, a
Warren
little
Buffett calling earnings per share overrated. I think that he has an excellent argument on his side. But I think the reason this is an important topic to call out is that if you watch financial media or if you just watch headlines from companies reporting earnings, what gets all of the focus and all of the glory? Earnings and earnings per share. Did it grow? Did it beat expectations? That is what the financial media hyper focuses on. It makes sense because it's a number that reflects the profitability of a company. Is it growing? Is it shrinking? However, in Buffett's 1979 letter to shareholders, he made a pretty compelling case for earnings per share not being the primary thing that you focus on when judging how well a company is doing.
So what is the thing that he suggests you focus on?
So according to this letter, Buffett essentially said that earnings per share is important or should be looked at, but if you only focus on earnings per share, what you are effectively focusing on are the output of a business, right? The thing that comes out of the business. But just focusing on earnings alone ignores what went into the business to create those earnings per share. So Buffett says that actually, rather than solely focusing on earnings per share and output of the business, Buffett wants you to focus on the ratio of what went into the business to what comes out of the business. And he there is specifically talking about the return on capital that the business, or more specifically the management team, gets from taking the capital that was put in and using that capital to create the profits.
So how can we measure that ratio? He throws around return on equity and return on capital a lot. So maybe we could talk a little bit about both of those.
Yeah, there's actually multiple ways to measure what kind of return on capital a business is generating. And this is something that personally I struggled with for years. Like the math behind these numbers or these terms is not hard. It's very, very simple. It's just very simple division. What I personally struggled with was why this was important. Like why this is a thing that investors should focus on at all. Because it's very easy for me, at least, to be like, okay, earnings per share times PE ratio equals stock price, right? And that's the thing that I care about as an investor is what happens to the stock price. Return on capital equations don't always relate to the company's stock price in the future. So it's more of an ethereal connection between the two to focus on. But to answer your question, there are four primary ways of measuring a company's return on capital that are fairly popular. There's more than this out there. I mean, there's lots of ways to calculate this, but there are four primary ways. So return on invested capital, ROIC, which I know you guys have covered on this show a lot, and I'm glad that you do. Number two is return on equity. This is the one that Buffett himself has been kind of beating the drum on for the last 40 or 50 years. I have a hunch, though, if you were to ask him about this today, he would say that this number is less important because it's the easiest one for management teams to manipulate, or it's the most likely to be way off of giving you useful information. Then there's return on assets, which is primarily useful for measuring very capital-intensive businesses like banks, insurance companies, or industrial companies. And then the fourth one is return on capital employed, or ROCE. But using, I would say, all four of these return on capital ratios in conjunction with each other can actually give an investor a better idea for what kind of returns businesses are generating with the capital they have.
Yeah, those are good. So do you have a favorite out of these?
So if you forced me to pick a favorite, I would probably choose return on invested capital, ROIC. So the formula there is net operating profit after tax, or NOPAT in the numerator, and then average invested capital in the denominator. And what this shows you is what kind of return, or what the interest rate is, if you will, that a company is getting from deploying the capital that it has. So companies, generate or raise capital from investors, from lenders. They deploy that capital. They use that capital to buy or build assets. Those assets then go on to create profits, which there's many ways to measure profits. So it's really the ratio of what profits those asset generates to what capital went into creating those assets in the first place. And of the four, I think that ROIC is probably the most useful and the hardest to manipulate. So it's most likely to give you an accurate representation of the return on capital that a business is getting.
So if we could back up for a second, you mentioned something I thought was fascinating. You said you kind of had this aha moment about, okay, I know the math, but this is why it matters. Can you walk us through that part? Because I can see a beginner investor saying, you know what? If EPS is up and stock price is up, I'm happy. Who cares about anything else? But obviously there's more to that than this. So can you walk us through that enlightenment that you had in the past?
Yeah, what really helps me is to put things in as simple terms as we possibly can. So what really turned me onto this concept was when I went through this exercise with investing in a bank account. So Andrew, pretend that I gave you $1 million. Congratulations.
Okay. I like this. I like this start.
I like where this is starting. Can I get in on that too?
So I give you this $1 million and I charge you 5% interest on this $1 million. So you have to pay me $50,000 per year in interest. Okay. So you take this $1 million, you go down to your local bank and you put that $1 million into a CD, a certificate of deposit, that pays you 3% interest. So $30,000. Is that a wise financial move for you? No, right? You're paying me 5% interest and then you're earning 3% interest. So effectively, what you're doing with this investment strategy is you're destroying $20,000 in value every year. I think everybody listening can understand that concept. Now, let's pretend that I'm happy with this arrangement. So I say, Andrew, here's another $1 million, right? $2 million I'm now giving you. And I'm charging you 5%. So I now make $100,000 per year. That's the cost to you. You invest that extra $1 million at 3%. So Andrew, you've now doubled your earnings. You were earning $30,000 per year. Now you're earning $60,000 per year, right? So if you were running a company, you'd be like, I need a bonus. I just doubled the earnings of this investment. But of course, was giving you more capital a good idea? No. You are now destroying $40,000 worth of value every year. So if you understand that concept, you can apply that exact same logic to a business. So how do we figure out the cost that a company should be charged for raising capital from investors and for lenders? There's lots of ways to answer this question. The academically correct answer is to use weighted average cost of capital, or WACC, and you take the charge of the equity, the charge of the debt, you weigh them appropriately, and you get some number. Let's just throw a number out there and just say 8%, right? Let's just say a company has an 8% average cost of capital. Well, if it's cost the company 8% to have access to that capital, the company has to then take that capital and earn a return on it that's higher than 8% in order to create value. If the company invests that capital and earns 8% or less, it's destroying value. Even if earnings are growing, even if its earnings are growing, if the company isn't earning at least an 8% return on this capital, then that is a terrible use of capital. That company does not deserve to have the capital that it has. So this is why Buffett says, don't look at just earnings per share. If a company is raising more capital, it should be growing earnings per share. That's not impressive, right? The company could be investing in a savings account and growing earnings per share with zero skill. What matters is how much capital they raised in proportion to how much earnings they're actually generating with that capital.
And to kind of bring it full circle, then the ROIC, ROCE, all of those are trying to tell you what a business is earning. And then you can compare that to a cost of capital or a WACC.
Exactly. So I like to think of that as kind of the interest rate that a company is generating on the capital that has been deploying. So as a very general statement, if I'm looking at a company that is optimized for profits, that's a very key caveat, by the way. If the company is optimized for profits and it's generating returns on capital that are 10% or below, that to me is a company that is destroying value. That is likely to be a stock that dramatically underperforms the market over the long term because it's not even earning the same rate of return on this capital that the stock market in general is delivering. If a company is earning, say, 10% to 20% return on capital, it's creating value. Not a ton of value, but it's creating value. And if I see a company that's generating more than 20% return on capital, you should want that company to have all the capital that it can get and to reinvest that capital as high as possible because it is creating a tremendous amount of value from the capital that's been given.
So we're having an intelligent conversation about cost of capital, which, as Charlie Munger said, is impossible. So this is kind of fun. What are your thoughts on the discount rate versus WACC and some of those, I guess, concepts in relation to what we're talking about?
Yeah, there's lots of ways to do it. Again, if you ask the academics, they will tell you that weighted average cost of capital should be calculated out to like 2 decimal places, and it should be a function of the risk-free rate of return times the beta of the asset that's out there. I mean, if you want to do all that work, have at it. I personally believe that that's just extra work for not much gain in response. My personal rule of thumb is that I use a discount rate of a minimum of 10%. Right? Because I can invest in just SPY or the S&P 500 and reasonably expect a 10% rate of return. So if I can do no work, buy the index and earn a 10% return over the long term, that to me is my cost of capital that I should charge any other investment that I make. Now, if a company is higher risk than the market in general, I want to charge even higher of a discount rate. So I know some investors that just apply a blanket 12% cost of capital across the board, and they make all decisions based on a 12% hurdle rate. So whatever you do doesn't really matter to me. I like to keep it simple and just say 10% cost of capital, and that's what I use as my discount rate.
And then how do you adjust for a riskier company or maybe one that is even like lower risk? Like, I don't know, throw out a name.
Microsoft.
Apple. Yeah, Microsoft. Perfect. So do you adjust that for a company like Microsoft versus maybe some small biotech microcap that you may be looking at? Would you adjust for that?
You certainly can. I personally don't, because if I'm going to be picking an individual stock, the first thing you need to know is, well, what do you want from that individual stock that you're not getting from the index in general, right? Mm-hmm. Most of the time, the answer to that question is a higher return. I'm picking this individual stock because I want to outperform what I could bet by just investing in the index in general. That is the usual answer. It's not the only answer. Another answer could be I want lower volatility. I want a stock that won't go down as much as the index when a bear market comes, which is why people invest in consumer staples and utilities and even a company like Berkshire Hathaway. Right? Berkshire Hathaway itself is a very low volatility stock. So if the market goes down 20%, you can probably expect Berkshire to be down like 10%. So just wanting a smoother ride is a reason to invest in a company. Another one would just be income. You want a higher dividend yield or a higher shareholder yield than what the S&P 500 is providing. So assuming the thing that you're after from an individual investment is a higher than the higher rate of return, I see no reason to dip below a 10% required rate of return, even if the business is lower risk, Because if the reason I'm investing in the stock is to get a higher than market beating return, it doesn't make sense to me to lower my discount rate, even if the company that I'm studying is lower risk or lower volatility.
Yeah. I want to hammer this point home about the relationship between the return metrics and the cost of capital, because I think a lot of people, especially newer investors, focus only on the art return metrics and don't think about the cost of capital. So can we kind of like, I guess, hammer that point home about how important that relationship is if you're going to invest in a company for more than 5 months?
Sure. Yeah. I mean, the discount rate or the rate, this is the required rate of return that you have as an investor for buying an asset. So it is a critical input to the equation to know if a stock's current valuation will get you what you're after. This is why, so the discount rate relates very closely to the valuation you should be willing to pay. There's nothing wrong with quote unquote overpaying or paying a premium valuation for a company if in exchange you, the investor, are either willing to accept a lower rate of return or a lower risk profile, or even if you're paying a premium, you think that the expectations built into the stock are too low and the company will outperform even slightly elevated expectations. But ignoring the rate of return that you want as an investor is foolish, because you could potentially be buying something that, even according to your own model, has no upside, which is not, I would say, a good use of capital.
No. So what are some good numbers when you're looking at return on capital ratios? Like, what ranges would you suggest people kind of keep an eye out for?
For me, I mean, there's lots of ways to judge this, and the returns on capital that you should expect from a company are very correlated to the industry that the business is in, right? Different industries have just different economic profiles. If you look at the tobacco industry or the pharmaceutical industry, those are industries that historically have had very high returns on capital. If you compare those to commodity industries or the energy industry, by contrast, the latter have much lower returns on capital. So the industry that you're looking in should have an impact on what you should deem as good or bad. However, with that caveat in mind, if a company is fully optimized for earnings, again, a huge caveat there, and it's earning a return on capital below 10%, I'm not interested. Like, no, thank you. That is a rate of return that is destroying value for investors. So I want at least a 10% return on capital before I would even consider it. I know you guys had Peter Compounding Quality on your show a week or two ago, and he said 15% is his minimum. But I think between 10 and 20% is a decent capital allocator, right? That should be something that's considered. And anything over 20% is truly a sign of likely a very excellent business. However, an important caveat with all return on investment calculators is that they are backward looking. They are what happened in the past. Was a company a good capital allocator in the past? And what really matters for investors is what will the returns on capital be moving forward? So I think Aswath Damodaran warned about this, that if you just use return on invested capital to make decisions, your portfolio could be filled with zombie companies, right? Companies that are big established brands that were dominant decades ago, but their time has since faded. And if their returns on capital are poised to fall and stay low, you will not do well as an investor.
No, not at all. Something else you said I thought was really interesting and worth zooming in on. You said a company has to be optimized for profit. Can you explain what you're talking about there?
Yeah, this is when marrying investing with the concept of the business growth cycle is just so critical. So I believe that there are 6 distinct phases that publicly traded companies go through in their life. So early in their life, they're in the raise capital phase. This is when they are reliant on outside funding sources, such as selling equity to investors or borrowing from lenders. And these companies are intentionally spending more money than they're pulling in revenue in an effort to grow. After a company graduates through phases 1 and phase 2, when they're really growing and depending on outside capital, They reach the break-even phase, right? When they're not making money, but they're no longer losing money. And then after that, they focus on optimizing the business for profitability, really taking through and maximizing the margins of the business. Only when a company has fully maximized its margin potential is it truly earning the profits that the business is capable of generating. And that's when a company should have GAAP profitability and free cash flow production. And NOPAT should be a number that you can easily see and measure. So only when those profit metrics are fully shining through and the company is optimized for profits do any of the return on capital calculations even matter. Because prior to that, if a company isn't optimized for profitability, then all of the numbers in the numerators of those equations will dramatically understate the company's true profit generation potential. So they'll all be far lower than they would be otherwise. So yeah, it's critical that a company is fully optimized for profits, and in stage 5, which I call the capital return phase, that any of these numbers matter.
Would looking at a company like Uber be a good example of how a company kind of moves through that life cycle? Because for a long time, I don't think they were really optimized for profits, but it seems like they're moving more towards that. So would that be a good example of a company, if you looked at them 5 years ago and you looked at the return on capital metrics, they wouldn't really tell you much, but now they could.
Uber is a great example of a company that has gone through the business growth cycle. So when Travis Kalanick founded Uber, it was like 2012, 2013, somewhere around that. The company was completely dependent on investors, outside capital, in order to fund itself. In fact, it was subsidizing the cost of its rides. It was purposely underpricing them in order to grow and to reinvest in itself. And it was only really a year or two ago, it was not that long ago, that the company even started to generate profits in the first place. So looking at Uber on FinChat right now, I see that the company has a 32% gross margin, a 5% net margin, and a 12% free cash flow margin. Now, I haven't studied Uber in depth. I don't know if you guys have, but let's assume that 12% free cash flow margin is sustainable. Like, let's assume that is the actual free cash flow generation capability of the company. Well, the company's net margin is only 5%. So which of those numbers is accurate? Is 12% free cash flow margin accurate, or is 5% net income margin accurate? Again, I'm assuming the 12% free cash flow margin is accurate. So even when looking at Uber's return on capital numbers now, you might have to make adjustments to the numerator if the company's profitability is still underrated. So it might still be too early to look at the return on capital numbers for Uber to draw any conclusions. However, it's getting close to the point, assuming the company stays on this profit trajectory, where these numbers will become meaningful, hopefully in the next 12 months or so.
Any companies you'd be willing to throw under the bus as far as examples of they kind of violate this kind of idea?
There's lots of examples that investors can use. But yeah, one that I'll throw out there is Alcoa. Alcoa, the big deal maker in the U.S., the big aluminum maker. I think it's Aluminum Corporation of America is what Alcoa stands for. But this is a commodity producer, right? It makes aluminum. It's by and large a pretty terrible business, right? The company has to spend billions upon billions of dollars to build these huge, massive factories. The demand for its products are cyclical, right? It depends. It needs really a strong economy to sell into, and its profit picture fluctuates up and down. So this company does not have predictable profitability. So if you look at its return on capital averages over the last 5 years, I mean, this is a business that was started in 1886. So it should be optimized for profits now, right? It's 140 years old. You would think it would be fully optimized for profits. When I look at the last 5-year average, I see return on capital employed of 7.4%. So this is a business that over the last 5 years, the average over the last 5 years has earned a 7.4% return on the capital that's been invested in it. Its return on invested capital, by the way, is 4%, and its return on equity is negative 4%. And that is a 5-year average. So none of these numbers are anywhere close to the minimum of 10%. And if you look at what Alcoa's stock has done over the last couple of years, it's not been a good investment by any stretch.
That's a good one. One that I've always interested in is Amazon. And that's because the company, whenever I look at companies and I try to explain how to look at financials, Microsoft's an easy one because their financials are very clean. It's a profitable company. It's just easy to use. But Amazon is, I think, a great case study because it's none of those things. And so how do you think about these kinds of concepts with a company like Amazon?
So the first thing you have to answer is Amazon fully optimized for profits? Are Amazon's financial statements, its income statement and its cash flow statement, fully optimized to show profitability? I would argue even today, the answer is no. Right? They're much closer today than they were 5 years ago, and certainly way closer than they were 10 years ago. But Amazon, to my mind, is not fully optimized for profitability. So I would argue that even today, Amazon's true earnings power is not truly reflected in its financial statements. But even with that caveat out there, I see that Amazon is earning a return on equity of 18.7%, return on capital employed of 10.6%, and a return on invested capital of 8.3%. Now, I think that Amazon, if it truly does start to really focus on profitability, that all of those numbers are understated and they should rise over time as the company continues to optimize the business for profitability. But this is the type of analysis that if you used it at any time over the last 20 years, would have given you the wrong answer with Amazon, simply because it hasn't been optimized for profits really at any point in its operating history. So this type of analysis, while very useful, does not apply to companies that are not optimized for profits.
I like this example. It's a business you're pretty familiar with, I'm pretty sure. What is it about Amazon that makes you reasonably confident that they're maybe not in the optimizing profit stage yet? Is it something glaringly obvious? Is it depend on the business? Is it specific to Amazon? Like what goes in your mindset there?
Well, Amazon is a bit of a unique case study in many ways. I mean, Bezos himself basically said that our goal is to minimize our reported net income and really focus on our cash flow. In fact, he said I think his 1997 letter to shareholders said, we're going to optimize for, was it free cash flow per share or operating cash flow per share? That's the thing that he set up the business for. So in an effort to minimize his tax bill this entire time and reinvest as much as possible, he has purposely understated the company's true earnings power. Now, if you combine that with the last 4 years, which have just been crazy, right? 2020, the company's sales went parabolic. In response, the company way overbuilt, way overspent on distribution centers. And then in response, the next year, to pull back on that spending and right size its sales force. So because of that, its expenses were overstated compared to its revenue. So if you look at the last few years, that fact alone makes the company not be able to shine through on how much profits that it has. And then in addition to that, you have to add this other wrinkle, which is Amazon made an equity investment in Rivian. And that now makes the company's net income a useless number, completely useless, because now the company's net income reflects what Rivian stock just did, which has nothing to do with Amazon, the business. So Amazon would be a great example of why you can't look at return on equity at all, right? Because the company's net income is in the numerator. So I think that my hunch is that if you fast forward maybe 2 or 3 more years, business will start to be optimized, truly optimized for profitability. And then these return on capital metrics will start to shine through. And for Amazon, I would ignore return on equity altogether. And I would just look at return on invested capital and return on capital employed. So we're getting close, but we're still not there.
So what are your thoughts on this potentially slippery slope of making adjustments when you're looking at different companies? Because yes, it logically makes sense to, for example, look at the income statement for Amazon and adjust those equity investments out. But then if you do that on one company, why don't you do it on this company and this company and this company? So what are your thoughts on that kind of concept?
Well, to me, every investment that you're going to make is always a one-off, right?
Mhm.
There's always something unique about that particular business that attracts you. So it's more important to me that you understand the nuances here when looking at any of these numbers. You can't just simply set up a screen saying, show me the highest return on invested capital companies. There's the companies I want to invest in. That doesn't work. I wish it worked. That doesn't work. By the way, if that did work, there would be no advantage to us as investors, because if it was just a matter of screening and buying based on a simple screen, computers would be the best investors in the world. So there's always extra caveats that go into interpreting anything about a business. Investing isn't just the numbers; it's a marriage of the numbers and the art of interpreting the numbers.
So the AI is not going to come and take all the stock picking opportunities away from us.
It's getting closer, but I would say not yet.
Is there anything else that we maybe have not touched on today that would be important in relation to return on capital metrics and earnings and costs of capital?
I think we touched on the main things. Again, the thing that I personally struggled with for years was just understanding why this was even important in the first place. If a company is optimized for profits and it is not earning return on capital that exceeds its cost of capital, and I'll just throw out there again the number of 10%, then if that company grows, it's literally destroying value faster than if it's not. So not all growth is good. Not all growth is good. And the way that you can tell good growth from bad growth is that growth coming where the returns on capital exceed the cost of capital, or they do not. So to me, that's the key takeaway from this type of analysis. You want to know, is growth producing value or destroying value?
Yeah, well said. And that's why one of my favorite statements is the capital allocation is job number one for CEOs. And this really goes a long ways towards telling you whether they're good at their job or not.
Yep, well said. So this is exactly why we started this with Buffett's quote about return on earnings per share is overrated. It is overrated. It needs to be married with what is the return on capital that the management team is getting. So it's a paired metric. It's not just one.
Yeah, that's awesome. Well, Brian, this has been a fantastic conversation as always. Where could people find more of you online? I know there's a few places.
Any social platform you can pretty much name. I'm on X, Instagram, TikTok, LinkedIn. So wherever you want to connect with me, Brian Feroldi, follow on.
Yeah, for sure. Definitely follow him. He's well worth your time. YouTube is a great place. They do lots of great explainer videos as well as some stock ideas as well. So it's lots of great places for Brian. So Brian, again, thank you very much for taking the time out of your day to come join us and share your knowledge with our listeners. And with that, I'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.